Ian Wyatt claims he knows 5 hidden AI stocks that have the potential to gain 1,355%. In this video, I reveal each of these stocks based on the clues Ian left in his presentation, saving you thousands in the process. If you appreciate this, just drop a like and subscribe. Also, no paid or proprietary info is given away in this video. It's all guesswork based on clues and publicly available presentations. There are many stocks to uncover, so we're just going to jump right into things. All the stocks are related to nuclear energy because Ian claims that nuclear will grow due to increasing energy demands from AI. Here are the clues left for us for the first stock. Ian says, this will quickly become the #1 uranium stock. It just began production last August. The US government just agreed to a $30 million purchase. Plus, the company has reserves valued at over $22 billion. Shares of this $7 stock could quickly jump 393%. Based on these clues, it seems the stock is Uranium Energy Corp, ticker UEC. I personally don't think this stock is a buy, and here's why. First is not profitable. UEC isn't raking in profits yet. Last quarter, they reported a net loss of $19.7 million, with zero revenue from uranium sales. With no cash flow from actual production to lean on, you're betting on hope, not hard numbers, and that's a risky play. Second is overbought and overhyped. This stock's riding on fumes. UEC's been called one of the most overbought names in the uranium space, meaning its price has shot up faster than its fundamentals can justify. When the hype fades, that drop could hit hard. Watch out. Third is production delays. Promises. But where's the yellow cake? Sure, they've restarted production in Wyoming and are prepping South Texas for 2025, but delays and execution risks are real in mining. If they stumble, those big production dreams could turn into costly nightmares. Fourth is uranium price roulette, too much hanging on the market. UEC's unhedged strategy means it's all in on uranium prices spiking, but with prices already cooling from their 106 peak, a sideways or downward move could tank their growth story fast. Fifth is geopolitical jitters. Supply chain chaos could crush them. With global tensions like Russia's uranium export threats and reliance on stable supply chains, UEC's US-focused strategy might not shield it from disruptions. One wrong move in the market and they're caught flat-footed. Here's what Ian says about the second stock. The founder of ChatGPT knows that AI requires huge amounts of electricity. That's why he invested in this next-generation energy startup. After investing plus $300 million, the stock just IPO'd. Grab shares today, before it jumps 389%. This company is small modular reactor maker Oklo, and the ticker is Oklo. I personally think Oklo is a borderline buy, and here's why. First is nuclear renaissance rocket fuel. Oklo's riding the wave of a nuclear energy comeback, with big tech like Google and Amazon betting on small modular reactors to power their data centers. Their innovative microreactors could be a game changer, but it's still early days with no revenue yet. Second is Sam Altman's star power boost. With OpenAI's Sam Altman as chairman and a major investor, Oklo's got some serious credibility and hype behind it. That kind of backing can drive interest, though it doesn't guarantee profits. Hype can fizzle fast. Third is green energy goldmine potential. Oklo's tech uses recycled nuclear waste to churn out clean, affordable energy, tapping into the global push for sustainability. It's a brilliant idea, but they won't have a reactor online until 2027, so patience is key. Fourth is cash cushion comfort. With over $288 million in cash and low debt, Oklo's got a solid runway to keep building without going broke anytime soon. Still, burning cash with no income means they'll need to prove they can scale profitably. Fifth is regulatory roadblock roulette. They've made strides with the US Nuclear Regulatory Commission, which is huge for a nuclear startup, but the approval process is a long, tricky beast. One delay could tank momentum, making it a risky bet. I'm going to reveal my guesses for the rest of the stocks in about 20 seconds, but before I do that, I want to remind you to click the link in the description to check out Alpha Picks. I reviewed over 100 stock picking services, and Alpha Picks performs the best and actually beats the market easily. If you click the link in the description, you get $50 off Alpha Picks. So go ahead and click that link and take advantage of this amazing deal. Here's what Ian says about the third stock. The US government has given just one company a virtual monopoly, with a $150 million contract. This single company is allowed to provide next-generation fuel for the Oppenheimer project. Shares of this stock could easily double or triple in the next year. Centrus is a tough stock to call, but I lean towards not buying. Here's why. First is volatile vibes, the roller coaster stock price. Centrus stock has been a wild ride with massive swings that'll give any investor whiplash. Its volatility makes it tough to predict and even tougher to stomach if you're not a thrill seeker. Second is debt drama. Cash isn't king here. Despite a big cash pile from recent convertible notes, Centrus still carries no net debt but plans to spend heavily on expansion, leaving investors wondering if that cash will vanish faster than it appeared. Third is uranium overload. Too much hype, not enough stability. The nuclear renaissance sounds exciting, but Centrus is riding a uranium hype wave that could crash if demand doesn't match the buzz. Over-reliance on a single market trend is risky business. Fourth is profit puzzle. Earnings are a mixed bag. Sure, Centrus posted a decent $73.2 million net income in 2024, but that's down from $84.4 million the year before. Inconsistent profits signal it's not a reliable growth machine yet. Fifth is policy peril. Government funding could dry up. Centrus leans heavily on Department of Energy contracts, but with a new executive order pausing Inflation Reduction Act funds, that $3.4 billion lifeline could be stuck in limbo. Big trouble if the government taps run dry. Here's what Ian says about the fourth stock. This is the only company approved to build a next-generation Oppenheimer project. A new contact means they could build plus 24 of these plants that can be connected directly to AI data centers. Grab shares today before they take off. My estimates suggest 426% upside potential. When Ian says Oppenheimer project, he means small modular reactors, and the company he's pitching here is NuScale, ticker SMR. To me, NuScale is a borderline buy like Oklo, and here's why. First is first mover advantage in the SMR game. NuScale is the only company with a US-approved SMR design, giving it a head start over competitors. Once they get their updated 77 megawatt design approved in mid-2025, they could dominate this emerging market. That regulatory edge is a huge deal in an industry where approvals take years. Second is revenues popping but profits, not yet. NuScale's revenue jumped 62% to $37 million in 2024, showing they're starting to make moves, like their Romania project with Fluor, but they're still burning cash and posting losses, which keeps this stock in risky territory. It's a growth story, not a profit play right now. Third is big partnerships equals big potential. With deals like the US Department of Energy's $900 million pledge and partnerships in places like Ghana and Romania, NuScale's got some heavy hitters backing it. Those connections could turn into contracts and cash flow down the road. But execution's the key, and they've stumbled before. Fourth is sky-high valuation. Boom or bust. The stock's up over 700% in the last year, trading at a wild 163 times forward sales. Growth potential is baked in, but if they don't deliver operational plants by 2029, this could crash hard. It's a high-stakes bet that's got me saying borderline instead of all in. This is what Ian says for the last stock. One tiny Canadian stock has staked over 700,000 acres, right next door to the number one mine in the world. They're sitting on 250 million pounds of uranium worth over $20 billion. That suggests the stock could be worth 1,355% more than the current price. This stock is Denison Mines and the ticker is DNN. I'd pass on Denison, and here's why. First is no uranium, no profits. Denison's still a dreamer, not a doer. Denison isn't producing uranium yet. It's all about future potential with its Wheeler River project, which won't even start until 2024 at the earliest. That means no revenue, just promises, and a long wait for any real profits. Second is Cash Burn City. This stock's bleeding money. Building mines ain't cheap, and Denison's spending way more than it's bringing in, relying on stock sales to fund its plans. That constant cash burn and dilution could tank the share price if investors lose patience. Third is timelines. That test your soul, years of waiting ahead. The Wheeler River project's first mine isn't producing anything yet, and the second one's not until 2030. Talk about a long-term bet. If you're looking for quick gains, this stock will leave you twiddling your thumbs. Fifth is execution risk explosion. What if the mines flop? Denison's banking on its mines being some of the lowest cost producers out there, but mines are tricky. Delays, cost overruns, or underperformance could crush those rosy projections. It's a big if that aggressive investors might not want to gamble on yet.